If you have not watched the discussion regarding recording long-lived transactions, financial transactions for fixed assets, you may want to go back and watch that before you look at this discussion, because we're going to build on that discussion and talk about intangible assets and natural resources. Now, as you probably know, intangible assets, they have a future benefit, but this benefit extends beyond the current year. What makes intangible assets different from fixed assets, from tangible assets, is that they have no physical substance. You cannot touch them. Now, for most intangible assets, we're going to amortize them over their legal life or their useful life, whichever is shorter. We're going to pick the shorter of those two lives. That's for intangible assets that have limited lives, like a trademark or a copyright or a patent or something like that. If it has a limited life. But some assets, like Goodwill as one example, may have indefinite lives. And for those, we're going to subject them to periodic impairment testing. More details on each one of these now. So let's talk about a trademark or a copyright. What's happening with a trademark or a copyright is, and you can see some of these I've listed up here. I actually went to Grand Valley State University's website, and I see that we have this list of registered trademarks, and you can see the little R with the circle. With a trademark or a copyright, let's talk about trademarks. Internally developed trademarks, like one of these right here, those typically have no cost and will not appear on the balance sheet. If you purchase a trademark from somebody else, then the trademark goes on your balance sheet at whatever the acquisition cost was. As you can see, these have value. If I want to buy officially licensed GVSU apparel or merchandise, I'm probably going to pay a few more dollars than I would if it were not officially licensed, because these are registered trademarks. Grand Valley State has the exclusive right to use these and to control how these are being used. And if you're not a student at Grand Valley State, you're a student at a different university, I guarantee you could Google your particular university trademarks and you'd probably find something very similar. Now, copyrights, that involves things like works of art or written works or musical works. Copyrights exclusively protect the right of that intellectual property, that artistic property. Copyrights, we're going to consider those to be the legal life of the creator plus 70 years. It's a really long time. So if we were to amortize a copyright, we would have to ask ourselves, is the useful life really this long period of time, the life of the creator plus 70 years, or is it a shorter period of time? We're going to amortize over the shorter of the two. Okay? Patents. A patent gives you the exclusive right to sell or manufacture a particular product. I have an example of a patent from, let's say, 1973. I believe I found this image. The cost is going to be your purchase price plus any legal costs needed to defend that particular product, that patent. Amortize over the shorter of the useful life or 20 years. Okay, so whichever one of these is shorter. Another example, you're familiar with these, franchises. A lot of fast food restaurants tend to be franchises. It would be difficult to drive around any major city and not find a franchise within a few minutes, just driving around. Now, if you have a franchise agreement, the holder of the franchise gets the right to deliver a product or service, use logos, use menus, use recipes, things like that. So if you want to be an owner of a Wendy's or a McDonald's or a Taco Bell, you're usually going to pay an initial franchise fee, and then there will be some kind of recurring fee on top of that. Now, each one of these franchises is going to have its own terms and conditions. But consider this, the initial outlay. If you wanted to build, for example, a McDonald's, you're going to pay an initial franchise fee to McDonald's. And then you're going to have to construct the building and buy the equipment and all that kind of fun stuff. Then there's going to be that recurring fee. That recurring fee could be a fixed monthly fee, or it could be a percentage of revenues, or it could be measured in some other manner. But usually there is some kind of a monthly payment associated with the franchise. What's going to happen with this is the franchise asset will be on the balance sheet, but those recurring fees will typically be treated as an expense. Then we get to Goodwill. Now, Goodwill, it's not just a place where Macklemore goes thrift shopping, okay? I mean, you know that you can go to Goodwill and you can find used clothing or something like that, or you could make a donation to Goodwill and they'll give you a receipt for a tax deduction for charity. But what Goodwill is in terms of financial accounting is when one company purchases another company. Okay, so mergers and acquisitions result in Goodwill. Let's talk about an example here. So take a look at this pizza restaurant. And if we looked at all of the identifiable fixed assets, I'm talking about this table, chairs, that sign on the wall, computer equipment, the stuff in the kitchen, these light boards over here, these video monitors, all of those fixed assets, let's say, have a value of $300,000. And we're just going to illustrate this by constructing a journal entry. So if we had identifiable fixed assets, and remember, this journal entry is from the perspective of the purchaser, the company that is buying this business. So if the identifiable fixed assets have a fair market value of $300,000, maybe an appraiser was hired to determine what these are worth, but the purchaser pays $400,000 to buy the business. I think we can get that to fit in right there. Think about what's happening here. We buy the business for $400,000. That's our cash outlay. What are we getting in exchange for that? Well, the fair market value of all the tangible stuff. It could also be intangible things like a franchise or trademark or a logo. But the fair market value of the identifiable long-term assets is $300,000. So the question is this. I mean, you guys know a journal entry has to balance, so something's going to get a debit entry of $100,000. The question is, what is that? Well, it's this mysterious thing called goodwill. And goodwill arises when a company pays more to purchase a business than the value of the actual physical or intangible assets that it's acquiring. So we paid $400,000 for this business and we're getting some furniture, fixtures, and equipment that really are only worth $300,000. Why are we willing to spend the extra $100,000? Well, I don't know in this particular example, but some things you could think about. Maybe the brand name has some value. Maybe we've developed some systems that are ultra efficient, that are valuable to the purchaser. Maybe it's location, maybe it's reputation. Any of these things could create value beyond the value of the identifiable assets, and that's goodwill. That's an intangible asset that has an indefinite life. We don't amortize goodwill for financial statement purposes. For income tax purposes, we do, but that's a different story. But for financial statement purposes, this indefinite life intangible asset, it stays on the balance sheet forever. It hangs around like a household pet. But we do need to test it for impairment at least annually, possibly more frequently if we think that there's some reason that the asset may no longer exist. That's what we do with indefinite life intangible assets. They stay on the balance sheet at their historical cost, but they get tested annually for impairment, possibly more frequently. And if there is a reduction in the amount of the goodwill, then we would record an impairment as necessary. What about licenses? Those have value. You probably have a driver's license. The state where you live grants you permission to drive a motor vehicle because you have a license. I have a commercial airplane pilot's license issued by the FAA. That means the federal government gives me a license to operate an aircraft. And businesses certainly need licenses. Take this example right here. Television stations need a license from the FCC, the Federal Communications Commission, in order to be able to broadcast. For example, I just searched a local television station here in my city, and the license was granted on October 10, 2014. Right, so they received the license October 10, 2014, and it is slated to expire on October 1, 2021. So roughly a 7-year period. Now, initially you might look at that and you might say, oh, that looks like a limited life intangible asset. Maybe we ought to amortize that over 7 years. Maybe, if it really had a limited life. But the reality is, the license to broadcast over the air is kind of like your driver's license or my pilot's license. It probably will be renewed indefinitely. As long as you don't have too many driving infractions, you're going to renew your driver's license for a pretty long time. And actually, my airplane pilot's license never expires. I have to get a medical examination periodically, but I hold the license indefinitely unless I do something really bad to cause the FAA to take it away. Same is true for this television station. Yeah, their license is going to expire in a few years, at least as of 2019 when I'm recording this video. But unless they do something really egregious, they're going to get renewed. They're going to spend a lot of money with an attorney in Washington, D.C. that will help them renew their FCC license, and then they'll have a license for another 7 years. So really, this is an indefinite life intangible asset that would be subject to impairment testing each year. Another example might be a liquor license. If you want to manufacture alcoholic beverages, or if you want to sell them either at retail or in an establishment like a restaurant or a pub, you probably need a license from your state. Now, that is an asset that has future value. You paid for this license, there's a cost, and now you get to sell adult beverages, which should help you with your revenues, of course. So that asset, depending on whether it's a limited life or unlimited life, would either be subject to amortization or subject to impairment. But licenses definitely have a future value, and we do need to measure them appropriately on the balance sheet and potentially the income statement as well. So let's look at just a couple of transactions involving intangible assets. Let's say that we paid $15,000 on January 1, 2018 to acquire a patent for a new type of conveyor oven. Well, the initial acquisition we're going to put into a long-term asset account, probably call it patent or maybe patents. And what's going to be decreased? Cash goes down. So we credit cash, that asset decreases, gives birth to a new asset called a patent. All right, well, we determined that the legal life of this patent is 20 years, but the useful life under our estimate is 10 years. So what we're going to do is we're going to amortize this asset at a rate of $15,000 per year. And amortization expense is really effectively like straight line depreciation as far as the calculation. The expense will be even throughout the year. So what we want to do here is let's then, at the end of 2018, we're going to record an expense, not unlike what we saw with depreciation. We're going to debit this expense. It has a different name because it's intangible assets, but we debit expense for $15,000, and then we're going to credit accumulated amortization. It's another contra asset account, a negative asset. Just has a different name because it's amortization instead of depreciation. But the concept remains the same. Now, some companies might choose to directly reduce the asset account. For example, you could just reduce the patent account with a $15,000 credit each year. I suppose you can do that, but I'm kind of a fan of using the accumulated accounts, these accumulated valuation accounts, because it keeps the bookkeeping a little bit cleaner. You still see the actual asset, and then we accumulate this contra asset. Let's see how this asset plays out over its useful life. As we know, the original cost of buying this patent, we had debited that to an account called patent, which is a long-term asset account, intangible asset. And over the course of this asset's life, all the way to its final year, or at least what we estimate to be its final year, that asset will have a debit balance of $150,000. And what's going to happen is this. After the first year of amortization expense, the accumulated amortization will grow to $15,000. $15,000 credit balance, negative asset, a contra asset, and that means that the net book value of this patent is $135,000. Next year, the year ended December 31, 2019, the income statement gets its own $15,000 expense, but that $15,000 expense causes the accumulated amortization to grow. Now it's $30,000. It's accumulating. It's growing like a snowball. Just like snow accumulates over time, accumulated amortization, like accumulated depreciation, it grows. But it grows in a negative direction, negative asset. So now the net book value is $120,000. And if we get all the way to the end of the estimated useful life, after recording amortization expense at a rate of $15,000 per year for 10 years, the accumulated amortization will grow to $150,000 credit balance, and that will exactly offset the patent on the balance sheet. And our net book value, I didn't quite get it between the lines, but I think you guys can work with me. The net book value is zero. Now, after this point in time, might that patent still have value for us? It's possible, yeah, but it's not going to be reflected on the balance sheet. We might still be using that patent to generate profitable returns for our company, but on our balance sheet, we have systematically allocated that cost to these 10 future periods because those are the periods where we believed we would be earning revenue, be receiving benefit from that particular asset. Finally, let's explore a simple example involving natural resources. So pretend that a company acquired this 40-acre parcel of land, and their intent is to harvest some of the timber on the land, and then, of course, sell the timber. It's a natural resource. So the company spent $100,000 to purchase 40 acres, and they believe that they'll be able to generate 5,000 board feet of lumber per acre. Board feet being a unit of measure for how much timber they can obtain from these trees. So that tells you if they think they can get a 5,000 board feet per acre times 40 acres, that means that they estimate, and again, this is an estimate, just like lots of things in accounting, they estimate that they will be able to harvest 200,000 board feet of lumber from this parcel of land. So, okay, that's over the entire life of using this land for that purpose. Let's pretend that in a particular year, they actually harvest 8,000 board feet. So the 200,000, that's still an estimate. That's an estimate for this parcel of land for the period of time that we intend to use it. The 200,000 is an estimate, but this is actual. The 8,000, we can measure how many board feet we actually were able to harvest. And what that tells you is that we've used 4%, 0.04 or 4%. And from there, the math becomes relatively simple. You take the cost of the asset, the $100,000, times 4% for this year. That is the depletion expense. Well, that's the depletion that we'll be recording, because you see there is this little nuance with inventory as well. So in this case, what we would do is we would say, okay, the depletion cost for this year is $4,000 because we harvested $4,000 of timber. Now the question is this. Okay. That gets added to the inventory we have available for sale. This still has not touched the balance sheet. I mean, it has not touched the income statement. It's staying in the balance sheet. So this $4,000 of depletion cost stays on the balance sheet in inventory, and only once we sell it does it go to the income statement. Okay? So assuming that we actually sell all this timber, then that depletion would become cost of goods sold and would be matched on the income statement with the revenue from selling the timber. However, if all we did was extract the timber and then we held it in inventory but we did not yet sell it, what would happen is that $4,000 cost would stay off of the income statement and would still be stored on the balance sheet in the inventory account. This is an overly simplistic example of natural resources, but what you're seeing is it's essentially like the units of production method of depreciation. where the depletion cost could be and probably would be different for each individual year, because next year we probably won't harvest exactly 8,000 board feet of timber. Might be more, might be less. In either case, the depletion cost will be different.